10 ways trusts can help you minimize estate taxes. Trusts are powerful financial tools that can play a crucial role in estate planning, particularly when it comes to minimizing estate taxes. By strategically placing assets into a trust, individuals can reduce the taxable value of their estate, ensuring more of their wealth is passed on to heirs rather than being lost to taxes. This method not only offers tax advantages but also provides greater control over the distribution of assets, protecting the financial future of beneficiaries. An irrevocable trust is a trust that cannot be altered or revoked once established. When assets are transferred into an irrevocable trust, they are removed from the grantor's taxable estate, potentially reducing the estate tax burden. Since the assets no longer belong to the grantor, they are not included in the estate's value upon death. This makes irrevocable trusts a powerful tool in estate planning, especially for high net worth individuals. Additionally, the trust can provide protection against creditors and lawsuits, ensuring that the assets are preserved for the beneficiaries as intended by the grantor. A charitable remainder trust, CRT, allows individuals to donate assets to a charitable organization while retaining an income stream for a specified period. Upon the termination of the trust, the remaining assets go to the designated charity. By transferring assets into a CRT, the donor can avoid capital gains taxes on appreciated assets, reduce estate taxes, and receive an immediate charitable income tax deduction. The income stream can provide financial security during the donor's lifetime, while the charitable contribution reduces the overall taxable estate. CRTs offer both philanthropic benefits and significant tax advantages. A grantor retained annuity trust, GRAT, is a type of irrevocable trust that allows the grantor to transfer appreciating assets to beneficiaries at a reduced gift tax cost. The grantor retains the right to receive an annuity for a specified term, after which the remaining assets pass to the beneficiaries. If the assets appreciate beyond the IRS determined interest rate during the trust term, the excess value is transferred to the beneficiaries free of additional estate and gift taxes. GRATs are particularly effective for transferring assets that are expected to increase in value, making them a strategic tool in estate planning. A dynasty trust is a long-term trust designed to pass wealth down through multiple generations while minimizing estate taxes. Unlike other trusts that may terminate after a few generations, a dynasty trust can continue indefinitely, allowing wealth to be transferred to future generations without incurring estate, gift, or generation skipping transfer, GST, taxes. By using a dynasty trust, the grantor can ensure that family wealth is preserved and protected for future generations, while also taking advantage of tax exemptions and credits. This type of trust is particularly valuable for wealthy families who wish to maintain financial security across generations. A bypass trust, also known as a credit shelter trust, is commonly used by married couples to maximize their estate tax exemptions. When one spouse dies, the bypass trust is funded with an amount equal to the estate tax exemption, and the remaining estate passes to the surviving spouse. The assets in the bypass trust are not included in the surviving spouse's taxable estate, effectively bypassing estate taxes upon the death of the second spouse. This strategy allows both spouses to fully utilize their estate tax exemptions, doubling the amount of wealth that can be passed on to heirs tax-free. A qualified personal residence trust, QPRT, allows homeowners to transfer their primary or secondary residence into an irrevocable trust while retaining the right to live in the home for a specified number of years. After the trust term ends, the property passes to the beneficiaries, often at a reduced gift tax value. The benefit of a QPRT is that it removes the home from the taxable estate, potentially lowering estate taxes. Additionally, if the property appreciates in value during the trust term, that appreciation occurs outside the grantor's estate, further reducing the taxable estate. An irrevocable life insurance trust, ILIT, is designed to exclude life insurance proceeds from the grantor's taxable estate, thereby reducing estate taxes. When an ILIT is established, the grantor transfers ownership of a life insurance policy to the trust. Upon the grantor's death, the policy's proceeds are paid to the trust, which then distributes the funds to the beneficiaries according to the terms of the trust. Since the ILIT owns the policy, the proceeds are not included in the grantor's estate. ILITs provide a way to ensure that life insurance benefits are fully available to beneficiaries without being diminished by estate taxes. A generation skipping trust, GST, allows assets to be passed directly to grandchildren or later generations, bypassing the grantor's children. This strategy avoids the estate taxes that would typically apply when assets are transferred from the children's estate to their heirs. By skipping a generation, the grantor can minimize the overall estate tax burden on the family. The trust is structured to take advantage of the generation skipping transfer tax exemption, allowing substantial amounts of wealth to be transferred without incurring additional taxes. GSTs are particularly useful for preserving family wealth and providing financial support for future generations. A spousal lifetime access trust, SLAT, is an irrevocable trust created by one spouse for the benefit of the other. The trust allows the grantor to transfer assets out of their taxable estate while still providing financial support to the spouse. The assets in the SLAT are excluded from both spouses' estates, potentially reducing estate taxes. Additionally, the grantor can ensure that the assets are protected from creditors and used according to their wishes. SLATs offer a flexible way to reduce estate taxes while still maintaining financial security for the surviving spouse. A Crummy trust allows a grantor to make annual gifts to beneficiaries that qualify for the annual gift tax exclusion. The trust includes a Crummy power, which gives the beneficiaries a limited window of time to withdraw the gifted funds. If the beneficiaries do not withdraw the funds, they remain in the trust and can grow tax-free, reducing the overall taxable estate. This strategy allows the grantor to transfer significant assets to heirs over time without incurring gift taxes, while also reducing the size of the taxable estate. Crummy trusts are commonly used in conjunction with other estate planning strategies to maximize tax efficiency. Thanks for watching the video. Please subscribe.